So let's move on to this inverted yield curve that we need to be hyper aware of. Everyone's ignoring it. They're not talking about it anymore. It was a hot topic last year in March when the yield curve first inverted. And what I'm referring to is the 2-year Treasury and the 10-year Treasury. Normally, the yield curve goes like this. You have your short term yields less than your longer term, right? So if you have a shorter term bond or a note, you're getting less money. If I have a longer term one, I'm tying up my money for a longer period of time. I expect more in return if I'm going to tie up my money for a long period of time. So what took place last year in March? Well, the yield curve inverted, meaning that short-term rates, the 2-year, is yielding more than the 10-year rate, which through history has indicated signs of sickness in the economy. And this sickness really doesn't start showing extreme warning signs based on history for anywhere from 12 to 24 months. And we're 17 months from when the Fed started raising rates, and 17 months when that yield curve first inverted. So we're in this window, but not quite at the very end of it. And there's also another thing that I want to point out. The money supply that was printed in the system was nearly 80% of the money supply that was printed 2020, 2021. So, it could take a little bit longer than that average 12 to 24 month period because there's so much money in the system. People had so much money to spend so they can get by as the economy and money supply tightens because they have cash in the bank, other investments, and places they can pull and get capital from. So I have a very important chart that I want to show you. It's from the St. Louis Fed, and this is what the inverted yield curve has meant throughout history. And then we'll get down to how accurate this is. So let's take a quick look. I want to pull this up for you. So this is, from the St. Louis Fed, and the pink lines coming down the middle, those big shaded areas in pink, are recessions. That line that says 0 going across the middle is that inversion line. And then the ups and downs, that blue line, if it goes below the 0 line, that is indicating an inversion. So you'll see the numbers are circled 1, 2, 3, 4, all the way until 7. This chart goes back to 1977. So the last 7 times since 1977, the inversion has always taken place before a recession. It has been accurate since 1977 every single time. And you can see what happens after these inversions take place. Folks, things get ugly, but not initially when the inversion takes place. It's generally when the inversion starts to de-invert. So and when I say inversions coming down, gets past that 0 line, and then the de-inversion starts to take place, that means the Fed starts cutting, and that's when we see the real true pain of that tight monetary policy. All right, quick look at the history and how accurate and how reliable is this. I showed you from 1977. But this thing goes back a lot further. But let's give you some data from at least from 1955. An inverted yield curve has accurately foreshadowed all 10 recessions since 1955, according to the data from Federal Reserve Bank of San Francisco. So it predicted all 10 of them since 1955. There was one false inversion that took place very quickly, end of the 60s, and that was the one false time that we've had since 1955. So as you can see, this inverted yield curve is very accurate. And we need to heed its warning and be cautious about our time frame of our investments. So I said, when you're making these investments, be very conscious how long that you want to hold these things for. We have the potential that we're going to see the economic consequences of the tight monetary policy coming very soon. So if you're getting in investments thinking that you're going to, hey, everything's going to be all clear, bright, sunshiny in the next year or two, as you can see, there is clear warning signs. Heed the warnings, folks. Obviously, there's a lot more at play. They can start printing more money. There's a lot of things that they can do to kick this pain down the road. And we have an election next year, so there's politics involved in that. So we have to be very aware. Tops of markets, you can make a lot of money depending on what market you're in, so keep that in mind as well.